All right, so let's begin the show. And today on the show, as I explained earlier, we'll be talking about having a strategy or reallocating your portfolio when your goals are almost getting accomplished or very near, and you have accumulated a huge amount of corpus. You obviously cannot take risk with that money since you have to be using that money for your financial goal. So let's get into this, and I have with me Shweta Rajani, Head Mutual Fund Anand Rathi Wealth. Shweta, good evening and welcome to the show. Shweta, let's talk about re-strategizing your investments when your goal is about to get achieved. Why is it important for one to do it, or why is it important for one to even consider? Because a different kind of strategy would be applicable for different kind of goals. We're talking about buying a house, your kids' education, your retirement. But just as you strategize the first step of your investment, there has to be a strategy where you want to start withdrawing money from your investment, and especially when the goal is around the corner. So why is it important for one to do it, Shweta?
Good evening, Kavita. Like you said, when we begin the investment journey, it is important to have a good strategy in place that can help you achieve the goal. So, as you're nearing the goal, in order to ensure that the last leg does not meet with any hindrance, you also have a proper exit, strategy and an asset allocation in place when you're nearing your goal. What will this ensure? It'll ensure stability of your portfolio towards the last leg of your journey. It will ensure that you have the required liquidity, as well as it will ensure that the risk element of the portfolio or the strategy is completely eliminated as you're nearing the goal. So it will these are the three main factors, I would say, why you need to have an exit strategy as well.
Shweta, so when we talk about financial goals, and we usually have to adopt a strategy when we talk about very important additional goals, which I mentioned earlier also, kids' education, buying a house, buying your retirement, buying a car. So each of these goals would require a separate strategy, a separate reallocating strategy when it's nearing the goal, or you think it's just one way, only one way that all of these goals can be revamped or maybe reallocated in terms of your investment portfolio?
No, so I would also actually bucket it, into different buckets. Let's say you will have certain aspirational goals. It could be, buying a dream house. It could be a car that you want to purchase, or it could be a holiday that you want to go for. Which means that at the end of your tenure, there is a lump sum amount that you need. On the other hand, there'll be mandatory or non-aspirational goals, which could be your child's education. That's mandatory cost and a goal that you will have to plan for. It could be a retirement. So retirement is going to come at a certain age, and you will have to ensure you've planned for it accordingly. So different set of goals in the first set. Even if it's pushed, let's say 6 months here or there, it will not create too much of a stumbling block. But a retirement or a education has to be paid off at that particular point of time. So therefore they have different natures, and they will need different strategies for those goals.
How important will it be to also keep your some money parked in the investments that you've already been investing in? So we get the part where you have to start withdrawing money and parking it in debt, which debt kind of an instruments that we'll come down to later. But how important it is to also let that money grow, because even if you need the corpus right now, the goal is about to, it's at the completion stage, but not necessarily you might be using the entire money. So how much of it should be left to grow, and how much of it should be withdrawn in order to use it to complete the corpus, the goal?
Absolutely. So the start point for this, I would say, Kavita, becomes that when you set your goal, you should also have a number target. Let's say you want a complete goal would be that you will need, let's say, 20 lakhs at the end of 3 years to buy a car. So, you will start planning, do your SIPs or your lump sum investments accordingly. And let's say you're at the end of 2 years, and you wanted 20 lakhs, you're almost at 18 lakhs. So this tells me that you're comfortable in achieving your end goal. In such a scenario, you can move 100% of this money into debt, let's say 1 year prior to achieving your goal, because debt will also grow at 7%, it will take you to your 20 lakhs of goal target. So in such a scenario, I would say for the initial phase, you can be equity heavy. 1 year prior to the completion of your goal, move towards 100% debt. It'll ensure goal accomplishment without having any concern on liquidity, without having any concern on where the market would go in the next few months. On the other hand, let's say this is a scenario where you wanted 20 lakhs, but you are almost at the end of the second year and you are already at, let's say, 21 lakhs. In such a scenario, maybe you need to move only 90% of your money to debt. The 10%, which is not something that you would need for the goal, can continue to be in equity and grow. So where I'm coming to is you will have to constantly review your portfolio to see how far off are you from your goal and what's the residual value required. If you are comfortable in 6 months, 1 year prior to your goal achievement and you've exceeded that limit, you can still have some portion towards equity. If not, 1 year prior, I would say move to 100% debt portfolio.
All right. So, Shweta, let's talk about the avenues that we are talking about. So, assuming that you've parked all your money in equity because you've had a strategy, weaved around it, how should you now reallocate your corpus? The concern over here is not so much to earn money or to earn return over the corpus that you've accumulated, but protecting your corpus. That should be the priority. So, what kind of safer investment instruments one should be looking on in debt?
Absolutely. So you have various options here. When I say debt, you can go in for a debt fund. So you can go, GSEC oriented index debt fund. That's, I would say, in terms of credit risk, it's sovereign. So it has the least risk there. You also have options of fixed deposit, or you can go in for an arbitrage fund, which works as a quasi debt fund. Just a comparison between the three. FD, if you go, you'll have to lock in your money for whatever 10 or 6 months, 1 year. If you liquidate it before that, there tends to be a penalty that you have to pay. Debt funds also, most of them don't have an exit load. But if they have a 1 year, 1 month, 3 month kind of exit load. So you can choose that. Arbitrage funds tend to have a 1 month exit load. After that, there's no exit load that you have to pay. The third consideration that you have to see is the tax angle. Now, if you are in a 20% or a 30% tax bracket, then an arbitrage fund may be better off than a FD or a debt fund for you, because the taxation for an arbitrage fund becomes an equity taxation, which means if you've held it for more than a year, then it will get taxed to you at the rate of 12 and a half. If you've held it for less than a year, then it's 20%. On the other hand, if you are in that 20 or 30% tax bracket, your post-tax return in a debt fund or an FD would be lower. In such a scenario, I would say you should opt for an arbitrage fund, because it meets the requirement of stability in returns, liquidity, as well as a decent post-tax return.
All right. Shweta, now any separate strategy or in terms of retirement, if I'm talking about a very crucial goal again, it's not a goal that will get done within a day. I mean, it's not that you use the money and then, you utilize it and you've completed a purpose. It's going to be there for the rest of your life. How do you then strategize this goal of retirement? How do you then strategize revamping your, reallocating your portfolio where you are using that money for retirement?
Absolutely, Kavita. You said, it's a goal, but it's a goal that will stretch for the next 15, 20 years of your life. So in such a scenario, the strategy should be that, let's say you are 5 years away from retirement, and therefore the portfolio asset allocation that you're maintaining is, let's assume it's 70 to 80% equity and the rest of it is in debt. As you reach your retirement age, or what you would need to do is, step one, you need to check how much would be the living expenses or your overall expenses that you would need for the next 3 years. That much amount is what you will move into debt, and the rest of it you can continue to keep it in equity and let it go, let it grow there. The 3 year period, you will do systematic withdrawals from your debt instrument. As you're nearing the end of 3 year, then it's a cycle, it will continue. Again, you will count for next 3 years of expenses and move that much portion from equity to debt. So this is a 3-year cycle that you'll have to keep doing on an ongoing basis. That should be your strategy when it comes to a retirement planning portfolio.
All right. So again, I think this is going to be case specific, and investors really need to plan it very well. Not only the planning stage for their goal, but also, reallocating it when the goal is almost getting completed or at the completion stage. Now, having said that, tax implications, will there be any, irrespective of the goal that we are talking about, since we are transferring that money from equity? So you'll have to, pay some tax over there because you'll be redeeming money, and then again from the debt options, when you'll be taking out money. So what could be the tax implications there?
Yes. So, see, the equity taxation today, as we speak, stands that if you are withdrawing your investments less than a year, then it's classified as short-term capital gains, where you'll have to pay a 20% tax. If you've held on your equity for more than 1 year, then it qualifies as long-term capital gains, and you'll have to pay 12.5% tax base rate plus surcharge and cess will be applicable. As far as debt is concerned, like I said today, arbitrage as a category, while it, from a risk standpoint, works closer to debt, the taxation over there is an equity taxation. The other debt fund categories or fixed deposits are taxed at your marginal tax rate, irrespective of your holding period. So if whether you've held it for 1 year, 3 year, 5 year, it depends on what is your highest tax bracket that you would be paying. It could be 10, 20, 30. So that's basically your instrument level of tax implication that you have.
All right, Shweta. This is what we have for the discussion today, and I'm sure there are a lot of questions that viewers might want to ask. We will also take upon queries related to their completion of financial goal. But we also have our viewers online connected. So, let's also start the live financial planning session, Shweta. I'm told I have Pankaj on the phone line with me, our viewer. Good evening, Pankaj. Hi. Pankaj, hi, can you hear me? Okay, we'll again try to get him on the phone line. So, Pankaj, Shweta, he says that he's got a target of 5 to 6 crores in 15 to 17 years. He's an aggressive investor. Monthly SIP he's been doing in mutual funds. He's given us all the details on that. And okay, so I'm not going to read out all the funds names because there are a lot of things information wise that he's given. But then once I have him on the phone line, we might just want to ask him a few more questions. But till that happens, Shweta, what is going to be your recommendation on his portfolio?
Sure. So I'm going to, jump on to his strategy. His goal was to get to a 6 crores. But given the breakup that he's shared with us, he has around 25 lakhs of lump sum, and he's also looking at 35,000 of monthly SIP. So, Pankaj, my recommendation for you here would be that you will need to do a step up SIP of at least 10% every year to reach your goal of 5 to 6 crores. So that's point one. Coming to the schemes, since you have a 17-year horizon, and I looked at the portfolio, I think you can go up to a 40-45% of mid and small cap in your portfolio. So which is where some of the recommendation that I am giving you is to exit from a Mirai large cap fund, instead going for an ICICI Pru Focus Equity Fund. You have a Mirai large and mid cap fund. There again, I would suggest you can exit from that and go in for a Canara Robeco multi cap. So your mid and small cap exposure goes up a little from a pure large cap exposure. Third one, you have an HSBC small cap. I would suggest instead of an HSBC small, you go in for an HDFC small cap in the portfolio. So those were my few observations. It'll help you spread out the different fund management styles. It'll also bring down somewhere your AMC and style concentration on the portfolio. I hope that
All right, I
helps
think
you.
I have Pankaj. I have Pankaj on the phone line. Pankaj, hi, good evening. So, So Shweta was actually reading out your portfolio details and giving you suggestions. So in terms
Okay.
of exit, mirror asset large cap, mirror asset large and mid cap, and HSBC small cap
Hmm.
is something that she wants you to exit from. Is there anything else you want to ask Shweta?
No, got it. Got it. Got it.
All right, all the best, Pankaj.
Yeah. Thank you. Yeah.
Shweta, Shweta, let's move on to Manoj's question. And okay, he says that he's got target is to have 5 CR in 10 years, and so far he's got 15 lakhs in sovereign gold bonds, he's got 50 lakhs in real estate, 2 lakhs in liquid, 5 lakhs in fixed deposit, 50 lakhs in ETF, has got 2 crores term insurance and health insurance coverage, family covering 30 lakhs for from corporate insurance. He's got Parag Parekh Flexi Cap, Nippon Small Cap, Motilal Mid Cap, Invesco Contra, Motilal Nasdaq 100, Tata Mid Cap Momentum, and Quant Active. And okay, so that's the portfolio that he has sent across. Um, okay, we don't have him on the phone line, but how? What about the balance in equity as and fixed income? Because he's well diversified. What I really like about his portfolio is he's got gold in it, he's got real estate in it, he's got fixed income in FT, and he's got liquid also, and he's got an equity portfolio. He's covered himself with term plan and health insurance. So I'm sure an investor who understands the basic principles of financial planning. Okay, so the changes that you might want to recommend, Shweta?
Absolutely, Kavita. So his portfolio, in terms of asset allocation, also he's ensured, it's not 100% equity portfolio. So he's got some amount of gold slash debt. I'm assuming the FD liquid fund, he's kept it from a 6 months emergency funding perspective, well covered in terms of insurance. Just, coming again to his goal of 5 CR, if he needs to get there, I think he'll have to do a 10% step up to his SIP every year. That I think will be a bare requirement. On his portfolio, the portfolio that way is well spread out. But a few observations I had was he has certain index funds in the portfolio. ETFs is what he has, which is avoidable. Over there, Manoj, you can go in for an actively managed fund, and we've historically seen, and given the way the active management space is still growing today, I think it's better off to be there. So the Motilal ETF, the Nasdaq one, as well as the Momentum ETF that you have, I would suggest you get out of those. And the third fund is the Motilal Mid Cap Fund that I would suggest you to exit out of. Instead, you can go in for an HDFC dividend yield fund, and you can go in for an ICICI Pru large and mid cap fund in your portfolio.
I have Mr. Arvind Kumar on the phone line with me from Chennai. Good evening, Mr. Arvind. How are you doing today?
Hi, how are you, ma'am?
I'm doing good. Thank you so much. Thank you for sending us your question. And you want to do an SIP of 15,000 per month. The corpus that you want to accumulate is 1.5 CR. What's
Yes,
the
ma'am.
time frame that you're looking at? Investment horizon, time horizon?
15 years.
15 years. Any specific goal that's tied up with this particular corpus? Is it the retirement goal or anything else that you want this money for?
Actually, my age 35, and actually my
Right.
two daughters, one daughter 6 year, one daughter 3 year, and that
Sure.
time
Okay.
education in marriage purpose.
All right. And you believe 1.5 CR will be enough for it?
Yes, sir.
Okay, because we're talking about 15 years, I hope you understand that how inflation really eats up your money. So I'm assuming that you've calculated all of that. We are talking about education inflation, which also goes up by 12 to 14% on an average. So anyways, we have our expert who can just align all of this for you and maybe help you understand in, further when you want to align your retirement or any other goal as such. Shweta,
Yes,
15,000 he wants to begin his SIP with, and 1.5 CR, 15 years.
yes, sir.
Yeah. So Arvind, 15,000 is a good start, but it will not take you to your goal of 1.5 crores. If you're doing a 15,000 per month, you may get to somewhere around an 80 lakh odd value. Taking into account how the historical track record of equity has been, what you will need to do is step up your SIP by 15% every year. and that will take you to your desired corpus of around 1.5 1.6 year. And like Kavita was mentioning, ensure that that's the value that you will need then, so inflation adjusted value. A portfolio that you can create, since you have a long term horizon, I'm going to create a basket which is well blended across large cap, mid cap, small cap, spread across different styles, so kind of a balanced out portfolio there. Few funds that you can have: go in for an ICICI Pru dividend yield fund, go in for an HDFC small cap fund, you can go in for a DSP equity opportunities. You can also add an HDFC small cap to this and an SBI contra. So these are the funds you can do an equal allocation and start off with.
All right, Mr. Kumar, is there anything else you want to ask Shweta?
No, this okay, ma'am.
All right, all the best. And with that, it's a wrap on the show as well. Shweta, thank you so much for helping our viewers with their financial portfolio queries today. And I'm going to leave our viewers with our WhatsApp number and email ID, because this is the only show where we do your live financial planning. So anything in terms of your investments or your insurance, or even getting you off the financial liability which you might have as a home loan, as a personal loan, credit card loan, anything you want our experts to strategize for you, you can WhatsApp your question to us, and you can also email us your query so that we can do your live financial planning on the show. Thank you so much for watching. Goodbye.
If you like this video, then like, share and subscribe to ET Now.